It is my pleasure to introduce Jamie POCOCK. Jamie leads the cyber analytics at Guy Carpenter in London. This includes developing the global strategy with respect to vendor partnerships and bespoke model development, with a focus on both affirmative and non-affirmative cyber risks. Jamie had joined Guy Carpenter in 2009, following graduation from the University of Bristol in 2008, with a degree in mathematics and physics. Initially, Jamie was working on US pension schemes. In 2014, he found out that general insurance is more interesting. Jamie qualified as an actuary with the IFOA in 2018. Please join me in welcoming Jamie. Jamie POCOCK. Jamie, the floor is yours.
Thank you very much, Andreas, for that lovely introduction. Let me share screen. Super. Good, Andreas. Do you mind just confirming you can see the presentation?
Yes, I can see it, and I assume everybody else can see it too.
Excellent, excellent. Good. Well, yeah, lovely to join you today. Good afternoon, good evening, and good morning to depending on time zones. And I hope it's been a really enriching conference so far. So this is the second of the cyber trilogy, and yeah, I really enjoyed listening to Matt's earlier, and I'm looking forward to Bethany's later. And we've gone for a little bit of a sandwich approach of the peril and focusing on silent cyber specifically for this middle section of this last stretch in the conference. And so yeah, I hope it's a really interesting and enriching section. It's a huge topic. Sometimes it's a slightly impenetrable topic, and so hence I've gone for a slightly open-ended kind of question-focused title here. What is it? What is silent cyber? Why is it a problem? And you'll see that kind of makes an implicit assumption there. And what can we do? So let's peel back the layers. And so today I will be breaking this down into a few different sections. So firstly, just focusing on what we're talking about. I think when we work day in and day out in a specific focus area, sometimes we lose sight of the fact that actually things that are second nature to us, the jargon, the lingo, the acronyms, etc., will be different for others. So I think it is really important to ground that definition. And I want to avoid repeating some of the good content and explanations you heard in the first presentation, and really focus a bit more on the silent cyber part rather than specifically the cyber only part. Next, then want to think about where it's come from. So what is this legacy of silent cyber? Why has it become such a big thing? And then thinking about, so what is the reaction of the market to silent cyber? Who's doing what? What initiatives are in place? And then coming into what will be probably arguably the most interesting section, which is how can we quantify it? And this is quite an ambitious topic in some ways, as we'll talk about this in more detail. But as someone of an actuarial background myself, I feel I understand some of the ways of thinking that we share in our community, and as such, I think there's an opportunity to discuss some of the things where we can actually apply some of our skills and techniques, but also kind of branch outside of our world with this topic. And then finally, I want to come into land with some concluding thoughts, and yeah, I look forward to sharing those with you. Good. So let's just kick off and just think about what we're talking about here. And I think in our industry, cyber is something that's, even if you're quite remote from it, it's something of a buzzword. It's a class of business which is increasingly ubiquitous, and and prevalent, and actually has been established as a class for a long time. But when we think about silent cyber, this is actually a different nuance. And so we can probably break it down into thinking in terms of coverage and risk. And this will be a little bit of a theme for today's discussion. So on the slide here, you have a number of key practice areas within insurance: property, casualty, general liability, D&O, just some example classes, well established, well understood, clearly needed by buyers, and clearly contemplating many types of risks. But cyber is probably not the first thing we think of when we examine these, but actually when we peel back the layers, cyber really is a medium for things to occur. It's a very broad term. And so when we examine how risks can manifest themselves in these established classes, actually cyber becomes part of the picture increasingly. And let me explain in more detail. So property damage, we tend to think of this following from natural perils or triggered by man-made events, and damages from things hitting things, fires starting, winds, floods, etc. But increasingly, there is a risk from the way the world is interconnected and the fact that internet-connected systems can be linked to operational processes. We've seen some historic precedents where these kind of cyber attacks have led to actual property damage. And then if you're a policyholder, you're looking at your property damage and you're looking at your property policy and thinking, well, this should be covered. Similarly, when we think about casualty covers a broad range of different classes and ideas, but it's typically defined in terms of impact of a party that's due to their actions potentially being negligent or not duly considered impacting another party. It tends to be fairly agnostic around the actual medium or causation or underlying peril. Okay, and so we'll go into a few more examples. Similar with general liability and D&O, these are established classes with the potential for events to occur in very different ways. So when we think about silent cyber, I think probably one of the first things I want to absolutely hammer home today is around coverage. And as an actuary, it's not something which I think necessarily comes easily to me and to us in the industry. We're more comfortable in some ways with dealing with numbers, exposure, claims, projections, etc. But this is fundamentally a problem of coverage. It's a problem of when you have a risk which may be present but was not necessarily conceived of. And so we have this schematic on the screen here. You'll see this fork in the road, cyber exposure, and then this middle bucket here, silent coverage, which is by contrast to the two either side, is this assumption that if something isn't spelt out in black and white in policy terms, then in some ways you could argue it's immaterial. Okay, so it's not affirmative. Affirmative really is categorically saying this covers this peril and it can manifest in this way. And excluded obviously is to contrast that by saying actually we cannot, claims will not be paid if they follow from these events. Now, if you think about what cyber is as a medium which increasingly relates to the emergence of technology and interconnectivity, be it of risks arising of malicious or non-malicious origin, this is a macro change, but insurance is centuries old. And so when we think about some of the legacy policy wordings that exist across all of the classes of business that our industry writes, many of these today will not adequately or categorically contemplate the potential impact of cyber-triggered events. So I think we need to think of this as the status quo. The default is that a peril would not be considered in a policy, okay? And so it needs an intentional effort from the market to actually consider, you know, when we examine class by class, is it intended that cyber be a trigger or a peril that is covered? And there's not necessarily a right answer to this, but I think it's very important to ask the question and work through the process. And you'll see on this slide as well, some of the recognized ambiguities from the market, the uncertainty in the communities. You'll see the stats at the top around the feeling that this problem is not or has not been suitably addressed. So it's not going away, and it's very important that we understand this is a problem of coverage in addition to the risk. So on screen here, you have a number of different classes of business. Now, we've seen the way that the standalone cyber policy has grown over the last few years. Now we're talking a multi-billion-dollar global class of business, which is much larger than some niche areas, but actually in the big scheme of things, very small. But when we see some of these established ones, you know, you look at working round clockwise, aviation and marine, two strong legacy classes. But these are increasingly exposed to the problems of interconnected systems and vulnerabilities and the potential for cyber-triggered events to lead to loss. Okay? And then similarly, if we keep going round clockwise, so crime insurance, this is the domain of frequently electronic crime. And so you can see right there, kind of the Venn diagram between that class and cyber is increasingly overlapping. EL, PI, D&O, product recall, etc. These are focused around third-party aspects, and maybe just to pick on one or two examples specifically, D&O really covers a certain type of third party against actions by a certain part of first party. And we've already seen many examples of claims arising from data breach events for D&O. So I guess a fundamental message here is that many, if not all, existing classes of business have some potential exposure to cyber. And some are more obvious and more prevalent and more evidenced and have more precedence than others. But this is something that needs to be addressed at a macro level. Because when you think of the problem of cyber, so a policyholder, a buyer of insurance wants to know that their risk is covered. Now, as the risk changes, it's important for the market to change as well and to contemplate how that plays out. Now, where might the loss arise? How might it arise? Matt alluded to the problem of aggregation, and cyber is hugely about aggregation. There are very significant unknowns that go with how much it can scale and how big an event could be. But similarly, it's also a peril that can lead to individual losses. As the risk changes, so must the market. As long as there are buyers that need coverage for this kind of risk, the market needs to be appropriately equipped to redesign these different types of coverage and ensure that the coverages that they offer continue to be relevant. So this is not a new thing, but it's certainly ramped up in terms of interest and focus in the last few years. And so you'll see on screen here, we have a timeline with some of the notable events. Now, these are, with apologies for the slight geographic bias over to the UK and the Lloyd's market in particular. The Lloyd's market and the PRA have generally been major drivers around this problem because it is a macro problem. And these these issues tend to be aggregating at a market level. And so as long ago as 2016, the Prudential Regulation Authority here started to express concerns around the risk of silent cyber, what it could become, how it could manifest itself, and really put the challenge to the boards of insurance companies to consider this risk. And this was followed not too long afterwards by the NotPetya and WannaCry events of 2017. Now, these were real shockwaves and probably really helped evidence the value of the emerging standalone cyber market. And Matt alluded to actually the fact that these did not uniquely see losses in that market, and that's correct. We tend to see a little bit of a spectrum of coverage, but we know here that actually for example, the NotPetya claim led to very significant losses in the property market, and this was where cyber was written as an endorsement, but there was some confusion as to exactly what that coverage was. So a very meaningful and material event which highlighted the relevance of knowing your coverage clearly. This was later followed by the PRA reaching out to CEOs and really ramping up the pressure to say this is a problem, it needs to be considered, it needs to be addressed. And then more recently, the Lloyd's market, in a couple of different bulletins, have been rolling out a plan to make Lloyd's syndicates compliant with a multi-stage process to explicitly call out whether cyber is covered or not in different classes of business. And so, and I didn't want to spend too much time on definitions, but I think it is helpful just to touch on the definition again here in the context of the way Lloyd's have framed it. So you'll see at the top, and there's my emphasis on a couple of points. Any risk where the losses are cyber-related arising from either malicious acts, e.g. cyber attack, infection of IT systems with malicious code, or non-malicious, for example, loss of data, accidental acts and acts or omissions, involving either tangible or intangible assets. Now that's a very broad definition. We know there are dimensions to cyber risk. We know there's a broad range of what that can mean. And so it's very important for the writers of risk to be cognizant of the very different manifestations of cyber. What could be relevant for a property writer that offers service interruption coverage that's exposed to US electrical power grid could be very different to a D&O writer whose buyers are concerned with the impact of a data breach wiping millions or billions off the value of a company. So a really broad range of interpretations, so we can't treat it too simply. But that said, the impetus in the Lloyd's market has been to work through by class of business in a multi-stage process. So we're some way through this process now, as you'll see from the dates. Phase 1 was focused around first-party property, arguably an easier and certainly perhaps a more logical place to start, in the sense that these tend to be the major aggregating classes. Where this then gave way to phase 2 in property and specialty classes, and some of the more varied offerings in terms of the Lloyd's coverages. And then phase 3, branching out now into classes like aviation, D&O, motor, liability. And that will be as at 1st of January of the coming year. And then phase 4 is casualty and marine. And this stage will probably be the most challenging in some ways. Reinsurance is not an area where typically the capacity providers necessarily have loads of granularity of the underlying business. And so you're going to have to consider now not just one original set of coverage or policy wordings that need greater clarity and the reduction of ambiguity around affirmative or exclusionary cyber offering. But also a second, which is the reinsurance contract. So this is not a quick exercise, but it's a very meaningful one. And it's very important that this kind of process, not necessarily in this way, but the ethos is replicated, because we need to, as a market, be prepared for cyber losses, cyber risks to manifest themselves. And we need to have clarity as to where those risks should ultimately be addressed. So in terms of options available, okay, so we can probably break it down into a few categories here. And so these are set out on this slide. We have affirmation, which is, it's essentially calling out the risk and saying this is covered. Now, the cyber is more than one thing. It can be a bit of a spectrum. The idea here is that once you affirmatively cover it, there's clarity, there's understanding around what this represents and what this covers. And there ought to be a commensurate pricing of that risk. Okay, so when you underwrite something, you should have an allocation of premium. Now, the second one is affirmation, but with sublimits. And this is quite common, certainly based on our experience of interacting with clients in the market. And here, this is a way to similarly call out clearly affirmative coverage, but actually to cap it. And there's a number of reasons why this might happen. An obvious one would be around the risk of aggregation in particular. Third, excluding. Okay. Now, exclusions are, for obvious commercial reasons, sometimes challenging to add, but this is the opposite of affirmative coverage. And in a sense, it shares that same clarity of language. It still requires a clear communication of what it is that's being excluded. Finally, exclusions, but writing back in specific areas of cover. We spent a lot of time looking at policy wordings and documents and the ways different coverages can be layered. And write-backs is a very common feature. And provided there is clarity, this is also a way to flex towards the actual needs of the client. So there's a number of different options here available in terms of the commercials. We'll see a couple of key names who have made very public declarations in terms of their stance. These kind of assertions are really valuable in terms of helping frame not just their organizations, but also having a market impact. We've definitely seen different clients of different sizes and stages of preparedness working through their own approach here, possibly in following regulatory pressure. But there's no doubt that it's really important for each entity operating in this space to have a clear and structured strategy around this risk. So getting on to numbers and quantifying, it's the part we all love. Now, it's not simple, okay? I often think the affirmative cyber market is a considerable challenge beyond what we're used to modeling, probably from slightly more established and more stable classes. And then when you add something like silent cyber, the additional dimension of coverage makes it more difficult still, okay? Because often we think in terms of the risk, and when the risk is uncertain, that makes it very difficult to model and quantify and price and allocate capital. But here we have the additional compounding uncertainty around the interpretation of coverage. And I think this event, so the Prudential Regulation Authority's insurance stress test exercise in 2019 actually bears this out. And you'll see on screen here in chart 5, compared a number of different events. So these are ratios of net losses to eligible own funds. So think of this as a simple relative measure to compare the different impacts of these events on books of business. And you can see 4 of them there are natural perils. Okay, and quite broad ranges too. And what I found interesting here was that the view from cyber was firstly hugely material. Okay, so you can compare it to set of 3 US hurricanes. I mean, we think about something like the Katrina, Rita, Wilma year and how impactful that was for the industry. Californian earthquake, I think needs no introduction. And Japanese tsunami, UK windstorm, etc. Hugely significant. Now, cyber already has been talked about in these similar dimensions. And don't forget that this is a view across all classes of business. So this is considering how a single event could lead to loss across property, casualty, specialty, life and health. So that was the first thing. And the second was, we found really interesting, was the array of different classes of business that were assumed to be impacted. Broad disagreement here. Property, E&O, crime, general liability, other classes. You'll see here the comments. 5 of 20 thought it would mainly be a first-party problem. 9 saw it being more of a third-party problem. So clearly there's a lot of work to be done here. Which brings us on to, what can we do? What's our role? How can we bring some assistance here? And as I start to wind down this presentation, I really want to kind of put some challenges out there around the role of analysts in particular. So firstly, understand the peril, examine the peril. So, but we're in a place now where the risk environment is changing, the peril environment is evolving, infrastructure that we rely on is increasingly moving, as we can very much see in this current period. So to understand silent cyber, it needs a foundation of understanding the cyber part. Secondly, focus on coverage. This is a multidimensional problem. It needs access to language and the ability to compare and contrast. Policy documents are huge, long, legal framings of coverage. It needs a lot of depth. It needs a lot of cross-examination, and it needs specialists. It needs working with people. We've found some success with actually deploying emerging tools to review these kind of things at scale. Okay, so there's a role for different approaches here, but it is important to understand that coverage is a key part of this problem. So we can't just come purely from a perspective of trusting data that we receive blindly. Thirdly, incident and claims information. So we're increasingly seeing cyber-triggered claims across the board, and a couple of key classes listed here certainly account for a broad proportion of those. But this is really valuable to actually build up a stock of information, and to be equipped to understand the kind of experience that an organization actually has. Okay, so we like data. It's important to start to collect it, and we're certainly seeing that in the market and among clients, including, to point to the Lloyd's market, the recent inclusion of the property damage, cyber-triggered property damage risk code. So building out a data set and starting to understand the experience. And then the exposure, from the exposure side, aggregation scenarios are really, really valuable. Okay, and that leads me nicely to my next slide here. And I think we can sketch out a brief framework. This is not necessarily prescriptive, but we know with this problem there is aggregation potential. And there is aggregation potential across many classes of business in a way that may not be replicated by many, if not any other underlying perils. So as a very simple kind of guide, we find this process very helpful. When we think about cyber can manifest itself in different scenarios. This might be quite specific and tied to a specific disruption of a infrastructure provider, or it may be a self-propagating malware campaign. And Matt and Bethany for sure will have covered this in much more detail than I by the end of today. But it's important to frame the problem and frame it in terms of specific pathways. How can it play out? What will be the technical narrative? Okay, what's realistic? How could it follow? How could it play out in practice? And how is that believable? How is it realistic? How is it credible? And then thinking around key drivers of loss. So where would the losses arise and why? Okay, which classes are most exposed? Which ones, are more marginal? There'll be some where you can definitely see claims arising, others it's a bit more speculative, and it depends on how the scenario plays out. Then how can you build a repository to evidence or back up your scenario? What examples are there out there? The near misses, the counterfactuals, the precedents which inform what you're constructing. Then build out a method, an approach, and finally feedback, iterate, test. And this is an approach to think around constructing scenarios. I think we have a big role to play in this space, but this is a much broader problem. So as I come into land here, I want to leave you with a few thoughts here more widely around what role we can play and how to help play a part in moving the industry to a more informed and more resilient place. You'll see the strapline here, moving from an unknown unknown to a known unknown. And I think that's apt. Many of us would have heard the original quote before, but this alludes to the fact that there is a difference between understanding the limitations of our understanding with respect to something, but building a strong framework around it, versus washing our hands and not taking any action and just leaving it as a fog that could potentially have much greater impacts at a later date. So my 9 final thoughts here. Don't defer, okay? This is a peril which is only going to grow. We see this daily. We're hugely aware of the way interconnectivity and technology is completely turning our working and professional and personal lives upside down. So it needs strong action, it needs it now. Secondly, understand the difference between cyber as a peril and as a product. Okay, so this being the middle kind of sandwich presentation is really more focused around cyber as a peril. Now, these are overlapping terms, just to be clear. But we can think of peril as the thing that gives rise to loss, and the product as the very specific standalone cyber insurance product. We need to get to a place where the product is much more considered, more widely encompassing, and the capacity is meeting the risk where it should meet.